Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look at the overall markets. It looks like we're selling off here. So the overall markets are probably going to head lower. We've got interest rates going up. This is exactly what happens under an expansionary phase of real estate where the housing starts start to come up. We get inflation or credit expansion from those housing starts. Interest rates chase that inflation higher. And the stock market usually sells off because the stock market with low interest rates, as long as they've been this low, it's been low for a very long time. They priced in very low interest rates. And when interest rates go up, the pricing mechanism of stocks and bonds are gonna price these things lower. So people are going to sell their stocks and bonds and rotate that money into commodities and precious metals. Sometimes in the beginning of these sell-offs, what happens is things will kind of sell across the board. It'll pull our commodity sector down a little bit with it, or slow it down at least. And then we'll disconnect from the overall market eventually, and that money will rotate back into commodities. So I think that's what's going on right now. I'm going to show you some of the charts. We'll take a look at it, and I can kind of show you what I think's going on. So this is the S&P 500. If we back out and do a 5-year look, it looks quite obvious to me that this is pulling back, and we're probably going to see a larger pullback here. If you just kind of put a portion there, and you were to chart, if I can select the right one here, it's an ascending wedge. We are squeezing on up, and we've broken to the downside for the S&P 500. If we look at the candlestick movements in here, what I'm looking for is larger selling pressure. And we can see the selling pressure getting quite large all through here. And the buying pressure in where those circles are at is very weak. So there's a lot of people exiting the market. They are selling off the S&P 500. It is breaking out of its pattern to the downside, and we're getting a pullback. That's what's happening. Is this a major market top? I'm going to say yes, it very well could be a major market top for the next 5 to 10 years. We could see a sideways chopping pattern over the next 5 to 10 years for the overall general stock market, not stocks in commodities, the general stock market that uses companies that use commodities. And the reason it is going down, in my opinion, is because of interest rates. And interest rates are going up because of inflation from the real estate market. It's the credit expansion coming from housing starts. We are also seeing this in the NASDAQ US Composite Index. You can see that this guy is rolling over. It looks quite obvious to me. What I was saying in 2020, in this period, as it was coming up, in this section here, I was saying look for a rollover at some point. I'm usually early. So what I like to do is I probably would have sold my stocks in here and maybe even in 2020 and rotated into the commodity sector like oil and uranium and all that. This here is on its last leg. It is definitely rolling over. If we look at the right-hand side, we have a bearish engulfing pattern right there. It started here, this whole section in here. We came up, we got a bearish engulfing there. We headed lower, and then it slowly leaked up into a bearish engulfing pattern. This means you're heading lower. This is a topping pattern. It's a throw over topping pattern. Then you get the big sell-off candlesticks everywhere in here. Bearish engulfing there, big sell-off candlestick, and they just keep coming. So this does look like a long-term topping pattern. I think it looks pretty much done for, and we're probably going to head lower. Does that mean our commodities are just going to head on lower? Maybe for a short period of time. I think we're already experiencing that in uranium and some of these other sectors. So I do think we're already experiencing it. And eventually what's going to happen is it's going to break apart, and we're going to go much, much higher because this money is going to seek a home. People are selling out of this. It's going to go into something else. And looking at these two major indices, one thing that we can look at is the Dow Jones to gold ratio. What that's going to tell us is how these are interacting with each other. Is gold getting a bid versus the overall market? And what we're seeing, and I'm going to just delete this kind of drawing I've got here. We came up into this pattern. It's an ascending wedge pattern. And we're coming up into the corner here, and yeah, we've got a bearish engulfing on the ratio, another bearish engulfing on the ratio, and we've broken the downtrend, or the bottom of this upward ascending channel, and we've broken to the downside. So what we are seeing here is a full alignment of the price breaking down on the S&P 500, the price breaking down on the NASDAQ, and gold starting to outperform the Dow Jones Industrial Average, the ratio. What that means is that money is starting to slowly leak out and come out of the markets, the stock market and the bond market, and roll into commodities. This is exactly what I've been explaining on the channel for quite a long time. It's playing out right now. Now, the transition period, I said I don't necessarily know what this will look like. We have very strong demand for oil. Is oil just going to rocket higher the entire time? No, but maybe. I mean, it's very hard to tell when these things start to break apart. There's a lot of leverage in the system. It's going to be a slow sell-off in my opinion, in the NASDAQ and stocks due to increasing interest rates. When interest rates go up, people perceive bonds as another alternative to get yield from bonds or treasury bonds. The 10-year yield is what I'm referring to. When rates go up, they call that the risk-free rate of return. And as your rates go up, stocks will be discounted to a higher interest rate. Now, the question you should ask is, what is driving interest rates? And really what that is inflation. Inflation is going to drive interest rates higher. And if inflation is persistent, which it's going to be from housing starts and this deficit in the housing market, we are going to have higher rates of inflation for, I think, a good period of time. So this money is not going to want to be in stocks. It's not going to want to be in bonds. It's going to continually roll out of it. And in my opinion, go into other sectors like commodities, precious metals, and real estate. There's been a lot of money that's rotated into these sectors, and the ratios have never been so far out of whack, which means a whole bunch of money has gone into stocks and bonds. And when it rotates out and goes back into commodities in the quantities that has shifted over there from stimulus money and all this other garbage money that's just been flooding into the system, it all went into stocks and bonds. When this rotates back out and goes into commodities, you're going to see very high rates of inflation. So to validate the thesis and what I'm telling you, just look for PPI, Producer Price Index numbers around the world, and look at what their numbers are. I guarantee they're going to be astonishingly high. Man, that's a really hard word to say. Oh my goodness. I'm not going to say it. Astonishingly high. They're going to be very high. And we are going to see a continued rotation into, I think, commodities. In the beginning here, it may dip, and then we're off to the races. So now's your time, in my opinion, to relax, get your shares, pick them up, pick them up, pick them up, pick them up. Get those temporary diamond hands, because remember, this is all cyclical. Or secular. It's going to be for 10, 15 years, something like that. Hold on to those shares and accumulate on pullbacks. That's my strategy that I'm describing here. And I'm going to ride it higher. The market conditions that we want to watch is the volume of loans in the housing starts. Housing starts recently has gone up. I'll show you that right here just real quick. U.S. Housing starts 1.702 was just updated, and it's a little bit higher in an expansion phase of real estate. So we've been chopping higher and higher and higher, and that's our driver of inflation. That's what's going to push interest rates higher. It's going to pull it higher with inflation. So we're starting to see the markets roll over. Now, if we look at a couple more, let me get out of here. We'll look at a couple more companies here just to get an overall picture. This is Chipotle. I spoke about it before. I said it was a topping pattern, and it looks like we're going to head lower. What I did is I looked at the highs here. It's a lower high, and then if we break this here, we're in a new downtrend. Chipotle is in a new downtrend, and it has topped as a pattern. What this is called is a Trader Vic 123. What you have to do here is you first break the uptrend line. So you break the uptrend line. It did a retest move. That's what this lower high is. So this is a lower high from here. And then we came back and broke and made a lower low. So what this is a topping pattern. This topping pattern is suggesting that we're most likely going to see lower prices in Chipotle in a sustained bear market. This is going to be a bear market for stocks. I've explained it on the channel quite well with the real estate cycle and where investing is preferable based off the real estate cycle. And we're seeing it play out right in front of us. Apple, I would suspect, is going to do a throw over top, which is what this is over here. If we were to look, more than likely you're going to see large selling candle days in relationship to the buying pressure, and it's going to continue to head lower for a good long, maybe even decade. So what I'm seeing is selling pressure. Amazon, you're going to see the same thing. You're going to see selling pressure. These are all going to be topping patterns, most likely to head lower. And that's what we're seeing. Amazon's topping. Facebook, you're probably going to see a top here and head lower. What you're looking for is that large selling pressure in here. Bearish engulfing there. Bearish engulfing here. Coming on back. Yeah, it hasn't made a lower low, so it's not technically in a downtrend yet, but you know what? I sure wouldn't be betting on this going to the upside. Alphabet's got the same thing. Bearish engulfing there. Big selling pressure here. Bearish piercing there. Bearish engulfing there. So you get the bearish engulfing, the bearish engulfing, the bearish engulfing. You're going to get some more selling pressure, and you're probably going to see this guy break this low right here. And now that's a lower low. You can see I'm just going to draw it in real quick, kind of a rounding top. So I think that we could potentially be seeing a top in Alphabet. Visa, it's already broken to the downside. It's done a return move, and we're probably going to head lower for Visa. MasterCard, I'm sure, is in a very similar situation. We're most likely going to be rolling over at some point. Looks like we're just chopping around right now, but it's probably going to roll over and head lower. The trade desk is heading lower. I had a throw over top, and it's ready to head lower. This is where you want to get out, in my opinion. Roku, another tech company. I'm just kind of randomly throwing tech companies in here. This one looks like it's broken a major uptrend line here, and it's breaking to the downside. More than likely, what you're going to be seeing are large selling pressure days in relationship to the up days, showing us that we are going to potentially head lower for Roku. If the inflation from the housing starts continues and remains strong, interest rates will continue higher. If interest rates continue higher, it's going to put a lot of pressure on these tech companies with high growth. What happens is when they discount future growth to today, they use an interest rate. That interest rate they use is usually the 10-year yield. When you do your net present value calculations with higher interest rates, it's going to show you that you should have less net present value. These stocks are overvalued as your interest rates go up. So they're going to sell off. So if you have a continual interest rate environment going up, if it continues to go up, these stocks are going to discount those interest rates and be sold off, in my opinion. And you're going to have a compression in your price to earnings ratio. And that's where it's going to be seen. So interest rates going up will compress PE ratios, especially those of growth stocks because the majority of the earnings are in the future and are discounted back with current interest rates. So in my opinion, I would not be, definitely not be, in the tech sector or software sectors or anything like that, because interest rates are going to eat them up. Something like we'll look at the ARK fund, ARKK. This one's a Kathy Wood fund. More than likely, she's banking on a whole bunch of stuff that I don't think she is using the right inputs. That's obviously my opinion. And what I'm seeing here is a sell-off. This is a $160 all the way down to $76 or so. It's selling off. It's in a large decline. Waterfall decline is what we call this. And it's probably going to continue for some time, so long that interest rates go up. So I would avoid that entire sector in its entirety. I would be more focused on the commodities and precious metals and real estate. That's where I would focus my efforts and where my money is being deployed. So that's what I'm seeing. I'd just like to tell you guys that it is rolling over. It may have an impact to commodities. It may drag it down a little bit or slow our sectors down. Be patient. Accumulate, buy the dips because we're in a bull market for commodities, and ride this stuff higher. That's exactly what I'm thinking. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't, and thank you for listening. This is Finding Value.